Hi and welcome to an introduction to management accounts for small charities. Today in this brief session, we're going to look at how management accounts can help build longer term financial resilience. We'll look at what management accounts are and why we think they're really super helpful for small charities, what they might include, and top tips and common pitfalls. What are management accounts? Management accounts are internal financial reports which we prepare monthly or quarterly. Our strong preference is monthly. They're useful for showing the financial position, informing the decision making, and communicating the financial position to relevant stakeholders. And that's adapted from NCBO's Good Financial Management Guide. We all have a finance cycle. Everything is underpinned with good financial governance. We start the year with a budget. We go out, do stuff, and have bookkeeping to track what's going on. We have a cash flow forecast to keep looking forward. And then we want a monthly finance pack that shows us where we've been and where we're going. At the end of the year, we take our bookkeeping data and put it in our annual accounts. And at that point, we do a reserves and resilience review, and the process starts again. Annual accounts are the public face of the charity. Management accounts are the internal face of the charity. They show us the heart of our organisation. They tell us what's working well and what might need fixing. There's no set format. With annual accounts, there is. It's very prescribed. With management accounts, there is not. We include what we find helpful, but there are, of course, some information that's often included. There are common pieces. There's the income and expenditure report, how much has come in, how much has gone out. The balance sheet, what we owe and what we own. The budget and actual variance report, what's not going according to plan and what is going according to plan. A cash flow forecast is really useful, and that will look at our future cash balances to see whether we can actually pay our future bills. We might have some charts which show what our risks are, and we might have a narrative. Good management accounts or good monthly finance pack would have words, pictures, and numbers. I think there is no one size fits all when it comes to management accounts. What we're ideally trying to do is create a monthly finance pack that's going to tell us the answer to some key questions. Are grants going up, overspent or underspent? Is there a risk we'll have to give some back or top them up? Are reserves going up or down? When will we run out of cash? Are we tracking the budget? If not, why not? What's changed? And what do we need to do differently as a result of what's happening in the numbers? It might also include a copy of the annual budget as a reminder of our original plans, an income pipeline, any social metrics to track our social impact, and our key risks. There's a wide variety of metrics that you can use. Common metrics, taking a risk-based approach is not a bad way to start. Common metrics might include future cash balances, target versus secured income, actual versus target reserves, or a cost per beneficiary. And we'll show some charts later as examples. Where does the information come from? So we start with the preparation process with management accounts. You set the budget, that's done at the beginning of the year. You might put it in your bookkeeping system, or you will keep it in Excel. The cash flow forecast is also set at the beginning of the year, ideally, when you do your budget. So you've already got these two bits of information. The bookkeeping is done monthly in our bookkeeping system, an Excel cash book or QuickBooks or Xero. And out of that, we'll get an income and expenditure report and a balance sheet. And so every month we are exporting all of this into one Excel workbook. Tab 1 would probably have the income and expenditure report from the bookkeeping system. Tab 2, a balance sheet, also from the bookkeeping system. Tab 3 will have a cash flow forecast, which we've probably done manually in Excel, but might come from the bookkeeping system. Tab 4 will have an actual versus budget report, which combines the budget and the income and expenditure report. And then tab 5 might have some charts. Once you've got all that in a workbook, we really want to go through a close down process every month. So, closing down is when we review and sign off what's in the system. And then after that point, any other changes are going to be done in the following month. But every month, we've ended with as high confidence set of numbers as possible. So, we prepare the draft report, step one. We meet with all the key people, review it, work out what we've done wrong, go away, correct it, finalise it. You might meet again, or you might just then close it down and save it as a final version. But that's then our most recent up-to-date finance report. And if you look at a good monthly finance folder, it will say something like month 1, version 1, month 1, version final, month 2, version 1, month 2, version final, and so on and so on. And I would aim to, we always recommend closing down the month, ideally within 2 to 3 weeks of month end. But if you can get it within 1 week of month end, fabulous. The more up to date the data, the better. Then, so you've got the preparation process where you get it all together. You have the close down process, and then you've got a review process. And so what we're doing at that review process is really looking at the numbers and thinking, well, are they actually reliable? How out of date are they? What's actually going on in the numbers once we're happy they're meaningful? What are the variances between the actuals and the budget? And what does that mean for our sustainability and for our beneficiaries? What do we actually have to do or change based on what the numbers are telling us? The balance sheet is going to tell us whether we've got any debtors and what happens if they don't pay us, or if we've got any creditors and whether they're still valid. It's also going to tell us how much we've had at the point of the balance sheet in cash. We want to know what's going on in funds, and if you've come to our budgeting session or a bookkeeping session, you know that we track funds in the budget, in the bookkeeping system, and in these monthly management accounts and in the annual accounts. Are we using restricted funds appropriately? Are any at risk of being unused or misallocated? And how healthy are our unrestricted reserves? When we're thinking about reserves, we're thinking, right, if we've got enough cash in the bank to meet upcoming commitments, and are there any months when cash flow will be tight? And if so, what are we going to do about that? And if you came on the cash flow session, you'll know that you either bring income forward or push expenditure back. Are we holding an appropriate level of reserves? Management accounts are where all the hard work comes together, folks, in one gloriously informative, timely, clear, simple, reliable finance report. Simples. And we do it really so we can keep the lights on. This is where the magic is. This is where finance really has power. The annual accounts are useful, but they're really a postcard onto the world. We're discharging our accountability. The management accounts is where we actually get the insight to keep making social change happen for as long as we're needed. And so, what do we say with management accounts? Well, we say there's no one size fits all. We've seen hundreds of sets of management accounts, no two are the same. But this might be not the perfect set, but an example of where you might start. So you're going to have a cover sheet with your charity name, the number, the financial year, so we don't have to keep remembering, and what period it's covering. Never forget the year. No one ever puts the year. And that's, the years go so fast. Just put the year down and make sure whether it's version 1 or version final, so we know what we're looking at. You're going to have a summary at the beginning. We've got 3 golden questions in finance. What are the numbers? We do a description of what the numbers mean, what they actually are. Maybe we're running a surplus budget with reserves aiming to be 1,000 at year end, in line with the policy. Maybe one grant hasn't been received yet. Maybe income is down. Don't worry, we've contacted the funder. We don't expect any issues. Maybe expenditure's over budget. Then we say, okay, well, those are the numbers. What do they mean? Well, actually, we think they're going to be resolved by year end, but we do have a problem coming up, and that does need a solution. And so the third question, what do we do? Well, how are we going to resolve this particular problem that we've got? Can we bring the appeal forward, push the grant back, push the expenditure back? So we've got one nice, neat, succinct summary, key numbers, what they mean, and what we need to do about them. Then we can look at the income and expenditure report. How much has come in, where from, how much have we spent, on what, are grants on track, are reserves going up or down? This charity has had 2,000 in and it spent £350. There's an operating surplus of £1,650, 175 of that is in grant 1, 475 is in grant 2, and 1,000 is in unrestricted funds. What are the numbers? These are the numbers. Then we're going to look at the balance sheet and say, okay, well, has that money that has come in, is it in cash in the bank, or is it in an invoice that was sent out and sitting in debtors? Do we have to chase it? And then we can say, well, we've received 2,000, we've spent 350, there's a surplus of 1,650. It's all cash in the bank. Fantastic. If it's a debtor, if it hasn't hit the bank and it's in income, but we've sent an invoice, it's sitting in debtors, we would need to chase them if they haven't paid within the time allowance. We might then have a report that gives our actuals, which is the same as our income and expenditure, but compares it to budget for the year to date. And we look then at the variances. Is income as we expected? Is expenditure as we expected? Do we need to take corrective action? This charity budgeted, second column in from the right, bright pink, budget total funds, to have total funds of 2,500. It spent £325. It's got 2,175 left. What has it received? Well, it's received just 2,000 in actual funds. It spent, in actual fact, £350. It's only got 1,650 left. That's interesting. Things have changed. Things are not like the budget. What's going on? Well, if we look at the unrestricted column, the actual income was 1,000. The budgeted income was 1,000. And actual and budgeted expenditure nil. All good. Nothing to worry about there. Grant 2, G2, had a budgeted income of 1,000, but we've only received 500. That's why in our summary we've said, well, actually, a grant hasn't come in full, so we do need to chase the funder. Expenditure for grant 2 was budgeted to be £25. It was actually £25. So actually expenditure is fine, but we are under budget on income. In grant 1, G1, we budgeted 500 to come in, 500 to go out, on budget, fabulous. In expenditure, we budgeted to spend 300, but we've actually spent 325. Now, what's going on there? Well, for that, you have to dig down again. So it's constantly being Sherlock Holmes. Bring out your inner detective. We budgeted £200 in grant 1 for project costs, but we've only spent 25. Well, a quick chat with the project manager will tell us and reassure us that maybe actually you just can't predict the timing of this stuff. It's going to be all right come year end. We're not going to worry too much now. Salary costs, we budgeted 50. We've had 50 in. We're on budget. Fantastic. Not going to worry about that. And then overheads, we budgeted 50, but we've spent 250. That needs exploration. Is the budget run? Have we overspent? Then we might just write down what we're doing. And I've gone past that summary too quickly, but you get the idea. You can download the slides and look at it at your leisure. Report 4 will tell us our cash flow forecast for the year maybe. And this is really telling us what our future cash balances look like. Can we pay our bills as they fall due? Do we need to take corrective action? So you can see here in the column on the far right, total income £4,000, total expenditure £3,000. But although we're predicting a £1,000 surplus, when we look at the closing balance, the bottom lavender line, we can see that the closing balance in January, February, March, April, May, June is positive, and then it goes negative in July, August, September, October, November. Even though it becomes positive again at the end of the year, we're expecting that. We're having a budget surplus. But the timing of the income is coming in after some of the expenditure's gone out, which means we're going to have an overdraft or a loan. And if we can't get those, we're going to have to take corrective action. We're going to have to push expenditure back or bring income forward. A good finance system, I tell you when you've got a problem, a really good one, buys you time to fix it. So we might then words, pictures and numbers, put our key risks in some pictures. We might map what our minimum cash balance is, which is maybe 1 or 2 months spending money. and then map our future forecast balances according to when we expect income to come in and out of the bank account. And you can see here that in just March, we're going to go beneath our minimum requirements. So that's going to make life hard work. You're going to have to watch the bank really closely. But in middle of July, we go negative. So we need to take corrective action. And now we've got time to do it. The chart on the right, target versus raised income, shows the target income for the year, which in this small charity is £1,000, and how much has been raised. And so far none, but it's only month one. That's okay. If we're still not expecting, if we still haven't got anything later in the year, we know when we need it to come in, because we're going to correct the cash flow forecast to make it work and bring the money in by then, and that's how we track it. Now, we might be a larger, smaller charity, in which case we might need something a little more complex like this. So the green boxes will tell us the total restricted that's come in compared to budget, the total unrestricted that's come in compared to budget, where we expect to land in restricted and unrestricted at year end and the year after. And then if we've got our opening balances and our closing balances, we can see our unrestricted funds or reserves now, if they're all in cash, our reserves at year end and our reserves next year. And that's really helpful. That gives us a shape of things to come. And we might have a one-pager that shows us our key risks, some composite resilience indicators in the bottom right that cover our people, our purpose, and our money, and a little bit of a narrative. So what makes good management accounts? Well, they've got to be timely. We suggest monthly. They've got to be accurate. There is a payoff between accuracy and timeliness. They've got to be informative. Don't chuck everything in there, including the kitchen sink. Only include information that's useful. And they've got to be accessible, words, pictures, and numbers. What goes wrong? We prepare them too late. They're so late that the information is useless. They only look backwards. We don't have anything looking forwards. That's really unhelpful. We've only got numbers. There's no words. There's no pictures. No one can really understand them. Even if they're beautiful and brilliant, no one understands them. We've got to do them for the whole village. And there's too much detail. There's not enough big picture. There are two common barriers. There's no time. We don't have time to do it. And I'm going to be honest with you. Time's always a barrier. There's 164 hours a week. I don't think it is time. No one's got any time. It's time and I find it boring. Time and I find it stressful. Time and it's difficult. I think the solution to all of those is probably to do it with a packet of biscuits and put in the diary. We say 1 or 2 days a month, half looking back, half looking forward, and don't move it unless the whole place is flooded. Only a real disaster means we move finance. Otherwise, it just never gets done. And the second barrier is we don't have the skills. Well, yeah, I get that. But can we buy them in? We need the skills. Our charity needs access to good finance skills. End of. We either develop them ourselves, teach ourselves, or buy it in. And you can sometimes get really super lucky, get a brilliant treasurer on board, get pro bono volunteer help. But never let one spreadsheet get in the way of changing the world. Management accounts are an integral bit of a good finance system, and a good finance system will tell us when we have a problem, but a really good one, which has a nice, simple monthly finance pack, will buy us time to fix it. Good luck, folks. Onwards and upwards.